You have 2 to 20 million, you're in a couple ETFs, your financial advisor is recommending some bonds. Maybe you only talk to your CPA in April. Maybe you even have a couple of real estate investments. But what you don't have is a system that is coordinating all of those things and making sure that you are not paying unnecessary taxes and that you have sufficient diversification and you're driving some income to help diversify your return streams. And so what I'm referencing is a micro family office or a family office light. And that sounds fancy, but really it's just a system that coordinates everything. And most people think they need to be a billionaire to be able to afford a family office, but that couldn't be further from the truth. And so if you have 2 to 20 million in investable assets and you have 20 to 30 years of future returns ahead of you, you probably shouldn't be treating that future wealth casually. That portfolio should compound substantially over time. And so it's probably worth looking at this concept of a micro family office. So that's what we're going to cover today. Okay, at a basic level, a micro family office has 3 different components. One, an investment policy statement. Why are you investing this money? What is the goal? What values does your family have? How much monthly cash flow does this portfolio need to generate? And what are you willing to risk to get to? Now, number 2, advisors that are talking to each other, right? Coordination. Number 1, that's typically a CPA. Perhaps it's a financial advisor, although you can fit that role if you have the expertise and the desire to do that. Now, you're not going to have all these people on payroll, but you do need, once again, coordination between them. You need a point person that is handling that communication and making sure that the pieces are fitting together and the strategy is aligned across those different vendors. All right, number 3 is your investments and how they are categorized. The purpose of this is to segment your capital to achieve different goals. I always think the first bucket should be income. How much monthly income do we want to achieve in our retirement indefinitely that we can slowly grow, but it takes care of all of our bills. We don't have to worry about selling any stock to fund our lifestyle. The second bucket is typically growth. It's focused on appreciation. It's for the money that you don't need now. You might not need it for 10, 20, 30, or perhaps forever. It's just going to be gifted to your heirs, your estate. That could be public or private companies, stocks or private equity, or we actually like to put our dividend growth stocks in this bucket because it might not be generating a large dividend today, but the compounding of dividend growth, it can get quite substantial over time and still get appreciation for us. So it's taking care of our income a long time from now because once again, even on the growth bucket, the goal is to generate income at some point. And now bucket number 3 is capital preservation. This is our safety bucket. This might be a year or 2 of your expenses that are just in liquid bonds, something extremely low risk that's not going to be part of a 30% drawdown if there's a problem with the broader economy. Okay, so that's the framework. But why do you need this? Problem is, if you are a successful entrepreneur, a successful professional, and you're also leading a family, your life is probably pretty scattered. There is a lot going on. And so you might not have thought through each of these individual items and have coordinated everything. So you're optimizing the returns to meet your goals, and you're also minimizing your tax exposure through tax strategy. So how do you architect this thing? There's some people out there that talk about this concept of a micro family office and they make it overly complex. They talk about having a board and having quarterly meetings with yourself and having controls and something called systems ops and checklists. And I actually think that's overly complex. I think that starts to happen at 30, 50, 100 million plus, like a true family office where you are hiring a staff and getting those details perfectly right is the difference between millions and tens of millions of dollars. I think about this concept of family office light in a different way. It's more about a mindset shift. You're no longer thinking about your portfolio of just these equities that are growing in value, hopefully, and are moving all over the place with the stock market. Instead, you're thinking about your finances, your net worth, as if it was an endowment, where it is going to last come hell or high water through whatever life is going to throw at your family. It is going to provide for you and your family and hopefully your grandchildren and perhaps even their grandchildren, right? Because the point is, you've already done the hard part. The hard part is getting this amount of money into an account that you control in your name. It's very difficult. That is extremely difficult. 99% of the world plus is never going to touch the numbers that we're talking about today. So you've already won the race, so to speak. Now is about making sure you do not mess it up, making sure that you are sufficiently diversified, that we build this system and give it the best possible chance deliver for your family indefinitely for as long as you need it without having to overly worry about what's going on with the individual stock market, which can get quite volatile at times. Because the vast majority of people, even when they get wealthy, do not treat their wealth that way. They overly focus on the S&P 500. They're often way too exposed to tech stocks. They don't have enough diversification in their individual equities, in their income vehicles. They have given zero thought to after-tax returns. They just think about that one painful day a year on April 15th. Many of them are using TurboTax. They don't have a CPA. And if they do have a CPA, they're only talking to them on April 1st, not June, when they need to be talking to that CPA on July 1st to coordinate for the following year. And some perhaps have dabbled in alternative investments in the private markets. Maybe they made an apartment investment or two over the last 5 years, some of which might not have gone as well as they had hoped, but there was little thought or upfront design in how they approached the private markets and what they were actually looking to accomplish, because oftentimes they just happened to invest in something because a friend recommended it or fell across their desk where they clicked on an ad and they reacted, versus being proactive and filling specific allocations that can deliver income and can also strengthen the portfolio and can make the portfolio more resilient against market downturns. Lastly, they probably haven't given any thought to entity structure and making sure they have trust in place. They've thought through their estate issues. They have a will set up, which is completely easy and understandable to punt because who wants to think about death? But once you've hit a certain level of wealth, you got to treat it seriously. You got to put these things in place. So that is a coordinated view. And that's 80% of it right there. This is stuff that you can do. You do not need to spend crazy amounts of money to put that in place, nor do you have to spend an inordinate amount of time setting all that up. That you just have to have every little thing lined up perfectly and every penny watched and in the right specific account at the right time. Unless you're an engineer and you just have this mindset where like literally everything has to be perfect. I think the 80% solution is a giant leap forward for your family's wealth to be in good hands. But if you're not the type of person that likes thinking about this stuff, that likes analyzing new investments and doing due diligence on fund managers and talking about tax strategy, and then making sure that that tax strategy and the investment plan lines up with what the CPA implements, if that all sounds painful to you and you've barely gotten through this video, well, that's when you bring in advisors. That's when you bring in professionals that focus on this thing all day long and actually enjoy it. For me personally, I know I could do our tax return each year if I wanted to slave away in TurboTax and grind out all that paperwork, but that takes a long time. And I would much rather pay our CPA to do it and have the peace of mind that the pros are involved. And so if you feel that same way about your investments or perhaps tax strategy and want to work with a professional firm that focuses on this, go ahead and apply down below and our team will reach out. Thanks for watching.